Well, good afternoon, everybody. It's a wonderful fall, autumnal afternoon in Michigan, although it is definitely brisk out there. My name is Mark Robertson. I am joined here by a number of my favorite friends in investing. They are a continuous source of ideas and inspiration, starting with our marvelous mathematician.
He still can't get it right. He still can't get it right.
Help me, Kevin. Help me.
Just keep going.
Magnificent
Okay?
mathematician from mid-Michigan. Magnificent. You just do that on purpose. I know you do.
I'm going to put that on a post-it so I can do it. Ken Kavula, how are you, Ken?
I'm doing just fine, Mark. Going trick-or-treating. I think I'm probably going to be handing out candy, but my granddaughter will be here in a couple of hours, and we saw her Sunday, and she was walking on the walls already. So we'll have to see if they've brought her down to the floor yet.
Yeah, I'm going to throw on my dragon costume and go out with my favorite 3-year-old dragon. And, it'll be fun.
The 8-year-old won't let you go with him anymore?
Oh, no, he tags along.
Oh, okay. All right.
Good stuff. All right, and also in our back room, joining us, Saturday Night Live style, Kim Butcher. Good afternoon, Kim.
Good afternoon. I'm having my front door worked on, so sorry for the background noise.
You are just a construction nirvana down there.
When the front door lock breaks and the way you're keeping your door shut at night is a piece of duct tape, yeah, I am.
Glad to know that you're keeping the local economy robust. Also,
yeah, unfortunately.
Also joining us this afternoon from the DC metro area / Baltimore and in that proximity, Kevin Gologly. Good afternoon, Kevin.
Good afternoon, everyone. Beautiful 53, pleasant weather here in Baltimore.
Cool. And were you pleased with the McDonald's earnings report yesterday?
No, I was waiting for you to heckle me on it all day long.
All right. And last but not least, joining us from Houston, he says with the sniffles, thanks to the second allergy season, Matt Spielman.
Yeah, I feel sad. We're only 51. We're behind Baltimore, but we'll make it back up by Thursday. We were just at the hardware store and we were placing side bets whether or not they actually stocked hand warmers for tonight.
Cool.
And they did. They are fully stocked at Ace Hardware.
All right, well, let's go ahead and get underway. We are going to talk about the Forbes and the Fortune fastest growing lists a little bit, tiny bit of an update on the Steel Cage Challenge, talk about our small company show that'll be actually tomorrow night at 8 o'clock in front of the October Roundtable, and then we'll just editorialize a little bit. But first of all, I want to brag a little bit about Matt Spielman. Matt, as you may recall, put on a series of sessions that described some of the psychology and bigger thinking areas of investing through the works of Joel Tillinghast and Annie Dukes. And during those sessions, he speculated about wouldn't it be neat if those two talked to each other? And I'll let you finish the story, Matt.
Well, I do. Annie has a it's not a Reddit, it's a Substack. With a broader view of management. In fact, she's written one other book, and there's one coming out, and in addition to finishing her PhD program. And I'm on the email list, but I'm not a patron. She also has a Patreon that she has regularly, some live Ask Me Anything kind of things. Well, she must have a slow Halloween or getting ready for trick-or-treaters, because she opened up her Ask Me Anything to email subscribers, freebie people, and I happened to notice the second comment on that was from Joel Tillinghast, and so they had a little bit of back and forth, and I had a pending question that I sent into Annie's email that was handled by her handler, but I hadn't heard anything back from that, which I'm not sad about, just hadn't. So I actually went back to that email, threw my question out, and she actually answered my question too. So not just Joel Tillinghast, but I myself have had a little conversation with Annie Duke today. So good day.
Very cool. Thanks. Good stuff. All right, let's go ahead and get underway. Our weekly reminder that Portillo's is not a sponsor of this session, but they should be.
Yeah.
Portillo's drive-thru is a late night must. Do you agree, Kevin?
I'll pass.
All right. Here's a reminder. I see a lot of very familiar names. Welcome back. No investment recommendations intended. This is all about education, and as it says there, it is to illustrate and demonstrate the philosophies, methods, techniques, beliefs, etc. of the modern investment club movement as interpreted by us at Manifest Investing. And it literally is the way that investment clubs have done things for nearly 8 decades, as championed by the National Association of Investors, Better Investing. So please do your own review of any company, do your own homework before making a decision. If we own something, we'll try to remember to tell you that we do. And so be careful out there. We do have our roundtable tomorrow night. It is a very special edition. We're going to start a half hour early and do our best small companies. We're going to wrap up a little bit of that shopping here today, but we'll also continue with our regular programming after that, basically sharing 3 or 4 investable, actionable study ideas with stocks. If you'd like to be added to the reminder list for that event, it is monthly. It's usually done on the last Tuesday of every month, 8:30 Eastern Time. This month is an exception. It's a special time and a special starting time. But send an email to ncavula1@comcast.net if you'd like to get that reminder. If you have anything on your mind, our 2 email addresses are down there at the bottom. Anything else you want to add, Ken?
No, you covered it well, Mark.
All right, let's try to zip through some stuff here. October has been pretty ugly. Unless we have an absolute miracle in the last few hours of the October stock market, we're going to have another really nasty close. So September and October have been brutal. And if you go back to 2008, 2009, you can find a period in time which was at least equally, if not more brutal. And I just love the quote from Mr. Buffett on the upper left. And I think he was right. What do you guys think? Anybody?
Well,
I think it's
Mark,
something like what is said about democracy sometimes, that it's the worst form of government ever created by man except all the others.
Yeah.
So we look at how the market goes and how just the output of and you say American economy, but let's just say our stock markets that we're familiar with. You know, there's not really a better alternative to go to at this point. However, it is in its market cycle.
It's got warts. And Ken?
Well, I'm not one to argue with Warren Buffett no matter what he says. I do take note of the fact that very recently he's made a statement that it's been very difficult for him to find stocks to buy. And I'm a little bit leery about that because I think I've found some very interesting stocks to buy recently. So we'll see who's correct in the long run. Probably Warren, but I'm going to continue to buy regularly and hope that the philosophy continues to hold and work for me.
Well,
at this point, Warren can't get anyone to break $100 billion bill for him either.
That was going to be my point, Matt, is that, he's fishing in a completely different pond than we are. We're on a lake. He's out in the middle of the ocean.
yeah, and he gets some completely different terms on his deals than any of us will ever see. So,
Oh, I wouldn't put it past a magnificent mathematician from mid-Michigan.
well, yeah, he does do some of that.
He does. He does get some great deals.
There's a reason that he drools around these regional banks. So anyhow, the point being that sometimes when it's pretty ugly in the stock market, there are actually 3 points on that graph: 2008, 2009, then the COVID period back in March 2020. That one didn't last quite as long, but it was pretty deep. And then we appear to be in a bit of one right now, kind of a moment. not as ugly as some of the others have been. Nick DiVirgilio did point out that the thing that was really different about 2020 was you didn't have time to microwave a hot dog between the.
No, that was you.
But Nick remembers. He
Talking
said,
to you at that day.
yeah, that day will go down in history. So anyhow, I think Warren was right. And I do think that, in this community, when you really put your head down and go shopping, when it's really kind of gloomy, is when you really can find some very rewarding opportunities. All right, here's a look at what has been going on the last few months. And as we have pointed out, that bar on the far right has actually been above the blue line not that long ago. So, what you're looking at here is the result of that. I mean, we were basically up here. We're now down here. And that means that the forecasts have moved up a little bit. So there's a few more things on sale right now, despite what Warren and Ken are wrestling over on the side. Okay, any other comments on this? We'll keep pressing on, because this is one of my favorite slides. You guys have seen this a few times. I thought I would share our Magnificent Seven, because what you're looking at here is the long-term performance of actually the 7 most widely followed companies at Manifest Investing on dashboards. The 6 up at the very top up here, Fastenal has come back a little bit, and just check out those returns. And again, very long-term returns. This is the actual annualized total return. This is the return on the Wilshire 5000 over that same period in time. This one minus this one equals this one. It's the answer to the question, how much are you beating the market by? And those are some pretty special numbers. And as we will show tonight or tomorrow night, we're back above 5 again on the investing roundtable for tomorrow night. Any comments or questions?
I just want to continue to say what I say every other month, and that's if you haven't hit 5 plus yet, don't be upset. Even a +1 is significant, and it adds a lot of cash to a 35 or 40-year nest egg when you've been saving for a long time, when you've been investing for a long time. So if your investment club's beating the market by 1 or 1.5 points, it's still doing quite well, and you shouldn't be ashamed of that at all.
No, it definitely stacks up over time when you have a few years in there. And even though the value line arithmetic average has been crushed here over the last year or so, especially the last few months, it's still pretty high on this list. And just kind of fascinating. Now, I do note that we don't have the same 7. There's 3 of them in there that are different, but 4 of them are in our top 7. And just kind of fun to think about the differences. I think I like our 7 better, believe it or not, with Visa and Fastenal in it. So
I know that our community, Mark, has always had a little bit of reluctance when it comes to Netflix and Meta or the old Facebook. I know there's always been a little bit of reluctance to put money into those stocks. Both of them have proven to be extremely volatile in price, if nothing else, over the last couple of years. I'm very happy with the top 7 that we have as well. And I'm especially happy with Cognizant and Visa. I've owned them both for long periods of time, and you just don't see the swings in price that you've seen in some of the Magnificent 7 in the last couple of years.
yeah, we're fortunate enough to own everything but Cognizant and Fastenal among those 7. And it's been rewarding, that's for sure, especially Apple. Okay, and Microsoft, as we will talk about tomorrow night, is the top performing selection all time for the roundtable. Okay, just a little fun with a couple charts. I like JC Peretz. He's on a frequent guest with Josh Brown and his Compound podcast. And this one is really an unusual chart. Two of our favorite things behaving similarly. Kind of surprised me. I'm not suggesting that there's any correlation between the two. There could be, but it's just an interesting chart. What are your thoughts, Ken?
Well, I always have a little bit of apprehension when I see a chart that is relatively short, like this one is. I would like to see the two lines, maybe for the last 15 or 20 years, just to see what's happened to them. I have a feeling that they do diverge quite a bit at some points, but it's certainly an interesting idea that they're tracking each other at the moment. And again, I can't come up with a reason for it.
Yeah, Sean likes to build charts and lay graphs on top of each other and try to draw conclusions a lot. So I see this type of thing often from him. Yeah, it's just one of those things. Kind of explains a little bit of the angst that we all feel because we do like those smaller companies and those financials also. All right. And then this one, just as a reminder, I hadn't seen it actually laid out so simply as this. I think that's something that probably has to be dealt with at some point. Just an opinion. It's a completely nonpartisan opinion. Just an observation. Any thoughts? Without getting political.
It's a true observation right now, at least, Mark. So maybe AI is going to prove to give us so much extra efficiency, so much extra. What's the economic word that we use to talk about how well you do your job and how fast you do
productivity?
Productivity. That's it. Productivity. Maybe AI is going to do that and narrow this gap right here, and maybe we're going to end up with. No, I won't even say that. I was going to talk about the Congress, but maybe I should just back off and just watch what's happening instead of talking about what's happening.
Oh, please share. Please share.
No. Let's continue, Mark.
Yeah, and my only comment is I can remember the article written back around the mid 80s, maybe early 90s by George Nicholson that talked of a peace dividend, and I don't think it's shown up yet. So that's all I'll say.
Yeah, my only comment would be, I mean, this is just the debt level. This is not the interest. So compounding this with increased long-term interest rates, the amount this is costing us annually is an even steeper curve.
Oh, yeah. All right, let's press on. Let's talk groundhogs a little bit. Lower right-hand side is a picture of somebody in a toddler dressed up as Punksy Phil. Gotta like it. Anyhow, I'm losing interest in this because I've fallen off the list, so I can't take it from here.
We maybe are showing it every week because we have a venue to show it every week, but it's interesting to see that we have a whole slew of clubs associated with Herb Lemkohl on this top 40 list right here. And Herb, if you're here with us today, just a big tip of the hat and congratulations. We had your daughter at our investment club meeting last night, and she told us how excited she was to be able to find a club that she could join virtually. So we're happy to have her as a member, and maybe she'll bring some of the same magic that you and the cool kids and the Cherry Capital Club and all those different groups have. It's just amazing to me how these clubs that you're associated with can continue to stay in the top 20 year after year after year. So
yeah, cool kids will be right up at the top in the all-time standings. This
no doubt about it, right?
February. Yeah, they're right up there. Right. And Herb is not far from the top. And I will thank both Herb as one of our guest knights and our guest damsel Kim for holding up our end on here at number 14.
Well, I think the thing is the kids group and all of us on the round table, we have a consistent process. So it gives us consistent quality for returns. If you keep that up, I think that's one of the keys.
Yeah, and the other thing I would point out is there's probably, I'll have to add up the number, I'll have it for you next week, probably 30 or 40 investment clubs amongst the 172 entrants. And that's a disproportionate number. They're bolded. The ones that are bolded with locations in parentheses are investment clubs. And there's quite a concentration per capita, if you want to think of it that way, which also goes to Kim's comment about those who discover, discipline, and then execute it. Good stuff. All right, we'll keep going. I will point out that these numbers continue to be as disconnected as I've ever seen. I might go back and actually try to find a precedent for it. Normally, the value line arithmetic average is higher or greater than the Wilshire 5000. And you can see that difference is pretty spectacular, really. And Ken, even on Halloween, the monkey continues to sink.
All right.
All right. So here we are. We only have a few hours left, and absent a miracle, not the best results we've seen in a while. So we are going to come in behind the market by one of the largest measures that we've seen. And there's no one single culprit on here. You know, normally, Ken, at this time of year, we sit and we admire the top one or two, and then we admire how the gains in those one or two companies actually offset the losses of 5 or 6 or 8 of them at the bottom.
Yeah, ain't happening this year, is it?
This is not one of those years.
This goes a long way to explaining why some of my groundhog things are down 30%. I have Malibu, Immode, and not Portillo's, and one more in here, maybe Fox Factory. So yeah, I got all the losers this year. Thank you.
We had a
I got
very
few winners there. Thank you.
we had a very unsatisfying discussion about InMode at our investment club last night, and decided to do nothing about it. InMode, if for those of you that don't know, is an Israeli company, offices in Tel Aviv. They don't do many of their sales in Israel, but they do a fair amount of manufacturing in Israel, and the stock has just been decimated. And the forward guidance that the company's been giving in the last month or so now has really dropped considerably. So I still think it's an idea that is going to be something that goes hand in hand with a lot of people as they deal with cosmetics and aging at the same time. But right now, I think it's quite an opportunity to take a look at least as a possible purchase.
Yeah, it's also one of the few companies, Ken, that's been featured as a beneficiary of the weight loss drugs.
Absolutely.
You know,
yeah, absolutely.
So I don't know. It's just kind of, hopefully it will be a situation that gets resolved fairly soon and it can get back on course. All right, so I don't think we need to talk too much about any more about these. I did prepare just for kicks. Anybody who wants to do a 3 or 4 dimensional analysis of what went wrong here, up at the top is what we were looking at a year ago. Now, I did identify one root cause, Ken. I think we should probably put the adult beverages aside this year as we make this selection. Because
if I remember correctly, only one of us was really happy about that dead rabbit over there. So
What's this we, Kimosabi? You went out all on your own. Some of us were trying to be reasonable.
Oh, geez. So anyhow, if you can start to draw some conclusions, I think the only thing I would urge caution on is maybe some of these lower, and again, this was the forecast 1 year ago. Some of these were in pretty rough shape, down in the lower single digits. Maybe that was a warning sign. Some of those also ended up at the top of this year's results. So again, trying to draw some type of a lesson from here. I do think that we did relax our quality standards a little bit.
Not only that, Mark, I think we might have just forgotten that in a 1 year contest, you don't have time to let diversity kind of fix itself as you buy and sell, because you're not buying and selling.
Yeah.
And we maybe forgot a little bit about diversity as well. Maybe we didn't need 3 financial companies in the mix. Maybe 1 or 2 would have been just fine in the mix. So I think we're paying a little bit more attention to diversity on this year's list, and when we show it to folks tomorrow, I'm hoping they'll agree with us.
Yeah, and the other thing that we believed we were doing is we had been selecting 20 companies per year, and then we talked about the rule of 5, and we just decided amongst ourselves, what if we just don't buy the 4 losers? With the rule of 5, and I think we got that wrong somehow.
Yeah, I definitely.
So the results are down at the bottom. They're within a few hours of being locked in, and they're unpleasant.
Well, when you're reducing your quality by putting in stuff that maybe has a quality of 27.5, that may be something to consider.
Yeah, but it's increasing eventually.
Okay. All right. Okay. Fine.
Okay, next slide.
Next slide. All right, so let's switch to this year's effort. This is just a quick reminder or a refresher of some of the places that we go digging for ideas. We're going to spend a little bit of time with the Fortune list, and Marie Frank brought that to us a few years ago, and we have continued to go back to it, gleaning and filtering for opportunities. The Forbes list was the original source of this idea or this exercise. Going back now, how long ago would that have been, Ken, the first time when we did this?
Oh, maybe a good 13, 14 years ago, Mark.
Yeah, it's at least that. I mean,
Yeah.
And if you go all the way back to the days of the iClub list, the email list for better investing, it's even more than that. But anyhow, these are our sources of ideas. We do like some of the fool's ideas. We like to glean those. Morningstar is a good place. Kathy Wood under the right conditions, and when she's not hitting the rabbit booze. No, I'm not suggesting that she does that. Sometimes some people have accused her selection process of being impaired. I'll just leave it at that. I don't believe that.
We need a new graphic for the SSG Plus, Mark. They've added a 5th preset, predefined screen, and that 5th screen really has some quite nice candidates for a small company. It's a different set of criteria, but they're equally as stringent as the criteria for the small company screen.
What's the general theme?
Well, the general theme is winners. Great stocks to take a look at, and in the opinion of the people that are doing the screen, there's the possibility that they're actually in the buy zone as well. But they all carry a small, medium, large tag, and you can sort them by size. So you can, if you're looking for just small, you can see what's there. Sometimes companies do overlap between the small company predefined screen and the other screen, but sure. But for the most part, it's another set of ideas. And pretty good ideas, pretty decent ideas. I think the stress obviously is on up, straight, and parallel. The stress is on real good, consistent growth over relatively long periods of time. So it's a really good starting point, I think, for an investor that's been at it for a year, year and a half, 2 years, and is starting to say, I'm having trouble coming up with candidates. Here's another place to find some candidates.
All right, I'll modify the graphic for tomorrow night, and we can dig into it. Yeah, Kevin.
So I was just going to say a slight correction. That's actually there's 6 predefined screens because underneath small company there's roster quality and then the A1, which is the new one.
Yeah, the
So,
roster of qualities not new. It's been there for a while. So
yeah, it's
so the
basically Ellis
graphic,
Traub's. It's Ellis Traub's deal.
yeah. So our graphic is needs an update there. Yeah.
Okay, I'll refresh away. Normally we spend time with Chris Jenner, and he's in more in the emerging healthcare area. This is Chris right here. We've got quite a few medical device companies on our list for this year, so I didn't go at Chris's ideas quite as hard as usual. Y charts for screening, other screening methods, Barron's and Investors Business Daily. Didn't spend much time with Hoover's this year, but that is kind of our collection of places where we go hunting for opportunities. And
Yeah, our October date is due to Forbes because they used to come out with their best small company list right before Halloween, right in the middle of October sometime. But they're now coming out with that list a month later, so they're doing it right after we declare what our list is. So it'll be interesting to see what kind of overlaps there are between what we choose and what they put on their top 100.
yeah, I'm fairly well convinced they're doing that to annoy us. But, all right, so here just to repeat what we're after, we do like rapidly growing companies, at least 12% growth. We're flexible. We do like excellent quality, but we're also flexible there. Good companies can make the list. And then we just simply want to find companies that have decent return expectations. So that's what we're after. So here's one of our favorites. Like I mentioned, this is one that Marie Frank first brought to us several years ago, but we've continued to use it. They've been doing it for 38 years. And they go ahead, Ken.
And it's so easy to get the sources mixed up and to get the names mixed up because it's Fortune with the fastest growing and it's Forbes with the best small. So make sure you get your source with the right list. If you do that, then you can access these lists online. They're not made for quick analysis. They don't usually have any tickers associated with any of the companies. So you have to kind of go around and identify each of the tickers if you want to put them onto any kind of a portfolio or a dashboard or anything like that. But it's worth the time, and I think we have them in Manifest now. All you have to do is go to the preset companies and kind of search for them, and they're labeled pretty clearly, so you should be able to not only find this year's, but you can find ones from years past as well.
Yeah, this year's complete list is on the homepage at Manifest Investing. And what they do is they basically look at growth in revenue, which would be consistent with us. They do track profits, so think of it as EPS growth. And then they also do appreciation, which I don't consider growth, but they both do it, both Fortune and Forbes. But that is kind of the three-headed monster that they go pursuing. And what I did, in fact, this morning, I ran into the Forbes list from last Thanksgiving. We'll show that next. I put that together in probably a half hour, and I had to do some ticker lookups like Ken was suggesting. But what I've done here is take the Fortune dashboard, Fortune 100 fastest growing companies, and basically sorted them, looking for companies with a growth forecast greater than 12, quality greater than 60, and a return forecast or projected annual return, in the sweet spot, somewhere in that 15 to low 20s range. And you get some interesting companies. Again, these are not necessarily small. I think it would be really hard to call either the top two small companies anymore. But there are a number of relatively small companies. And Ken, I think Monolithic probably is a threat to make it. Globant, InMode, Green Brick. This is a recent roundtable selection. We thought about Enphase, but it's kind of big. I think is XPEL amongst our finalists? They are, aren't they?
It's among the finalists. I don't know if it's made the list or not, Mark. I really like Clearfield up there too, but I don't know what's happened to it. It just seems to have fallen apart. It deals with rural rural creation of infrastructure for the internet, and it's just the stock price is just completely fallen apart for the company. But look at the anticipated growth number, and look at the anticipated par for it's the fourth one on the list there.
Yeah, I consider that one of the most annoying companies of 2023. It's completely wrecked our groundhog this year. It was selected by I think it was the most frequently chosen stock by groundhog participants. And if you chose it, you're not on that page that we just had up there, showing the leaders. It really has been stung badly. So it's worthy of a deeper study to figure out if it's as Cy Lynch would point out, is it terminal or temporary? The challenges they face.
And the analysis is one of those mystery analysis, Mark, where it looks like you're doing everything correctly. It just, you can't see where you've made any kind of a major error. And even if you go mega conservative, you still end up with the darn thing saying buy. And yet it's lost all kinds of money for anybody that's put money into it in the last 6 or 8 or 10 months.
Yeah, and I mean, part of my inspiration would be even Western Alliance when it dipped down so far, and basically a falling knife that you can take a chance on every once in a while. And you may recall, Ken, we do our moment of silence around the medical company. The name escapes me. But for 3 straight years, they'd behaved like Clearfield, so we leave them off the list, and they would have been number 1 the next year. So I'll probably bring that back tomorrow night.
Woulda, coulda, shoulda. That's just what happens,
Yeah,
It's investing.
Sean and I have a coulda, shoulda pile and stuff. So we are considering adding a bank. Dime will be on the late study list here. I think that's probably got a little bit of ambitiousness over here. I don't know. We'll see. And your old company, Inter Parfums, is on here.
Yeah, I did actually own that company for quite a while. I haven't owned it for a lot of years, but it was a company that I owned in the first part of this century for maybe 5, 6 years, and did okay with. It was never something that turned around and lost huge amounts of money. I just felt that it had not been growing the way I had wanted it to grow at the time I sold it.
Yeah, and Top Build is a good study too. It's a little bit bigger than, I think it's about a $5 billion company, so it's a little bit large for the small company list.
Interested that Fortinet's on here, Mark, because we put Fortinet into the roundtable portfolio when the par value was up near 20. So it has had a really good run. That's what drives the par down when the stock has a really kind of a rocket approach to its price. It drives the par down. 11's still not bad for a company this size. So another great one to take a look at it. And again, that comment that I made that NVIDIA might actually be investable right now. Look at that quality, look at that growth, look at that par. And look at the PE that's being used to achieve those numbers. They're not using, the analyst community is not using a PE of 45 or 55 or 65 to achieve those results. They're using a PE of 28 with growth of 28. So interesting, very interesting.
That's a roundtable stock thanks to Herb Lemko.
Yep.
Good stuff. All right, switching to the other publication. Now, this, again, is not a current list. It's actually from last November, but they're annoying us by publishing a month later than they ever did. After they annoyed us for a few years by covering unicorns instead of small companies, private equity unicorns. But what I did is I created the same dashboard. Took me all of a half hour, maybe 40 minutes to put all 100 companies on here, and then go to a worksheet where I could whittle it down for a list to look at. The complete dashboard is available down here at this link at the lower left, and you see some crossovers for sure. I also see a number of companies that had shown up on groundhog portfolios, but there's a number of companies here that were on our finalist list. I really liked this as a study, Dreamfinders Homes. I'd be tempted to hold Dreamfinders and Green Brick in a segment of my personal portfolio. Dreamfinders is more of a little bit more north and east than the Dallas connection down to Green Brick. But
Yeah, I want to emphasize to our audience that this 2023 list is from last year. This came out in November in last year, 2022. So the 2023 November list will be dated 2024 for next year. So keep that in mind so you don't get them mixed up. B.I. Baker Model Club here in mid-Michigan owns CSW Industrials. CSWI is the ticker right beneath Dreamfinders there. And that's another one that we bought when the par was up in the high teens, and the par has been driven down to 9.6 now, which means that it's been on quite a tear. It's not a company that anybody hears about very much. I have yet to see it in any other portfolio other than the Baker Model Club's portfolio, and yet it's one of the 2 or 3 best performers in the portfolio over the last couple of years. So a very interesting company. You might want to take a look at it.
yeah, so from top to bottom, these are sorted by highest quality, descending. Notice I snuck Lindsay in there, Ken.
There's that Richardson again too, Mark,
Yep.
that we've looked at a number of times down near the bottom of the list.
Yeah, there's some pretty powerful numbers there, and I'm not sure what we ran into on that one, but it's on the list of the nominated companies.
From last year, there's good old Clearfield again too.
I know it. spreading its poison
Yeah.
since last year. And
Yeah.
I will point out again, thanks to all of you a number of you have sent us ideas. The Denver chapter sent us a few along, and one of the featured companies that they asked us to take a look at was Catalyst Pharmaceuticals, and that's definitely got some merit. It's a little bit of a high flyer based on that par, but look at that growth rate. But definitely worth digging in a little bit deeper and at least being aware of it. So good stuff. All right. Anything else on this, Ken?
Nope. We beat this one up pretty good. Let's see what the next slide says.
Interesting crossovers. All right. So the gauntlet was thrown down. The steel cage challenge is underway. And so far, we're not doing too badly. Again, the premise here is to take and identify a company that you think is not is
Mark,
going to
we seem to have lost your sound. Did something happen?
I can hear him.
Oh,
Yeah, I heard him. Okay.
all good? Are you still there,
Yes,
Ken?
you're good.
All good.
Ken, are you there? I wonder if we lost Ken completely.
You may have.
He's there, but
audience,
he's
I don't
muting
know
us.
if you're hearing me, if you're hearing Mark. Maybe somebody could put something in the text box to tell me if they're hearing me.
Everybody
Yeah,
says,
you're back, Ken. You were gone. We've all checked in.
yeah. So I don't think it was on my end, based on what I'm hearing. All right. So here's the challenge, and it's just kind of a playful thing that we started a few weeks ago. Again, as it says, inspired by a morning.
Okay, I'm getting messages that people say they're hearing me, but Mark, I'm not hearing you. If you're hearing me, that's great, but I'm not hearing you.
I wonder. That's kind of hard to understand. Everybody else can hear me
Yep.
Yep.
Yes.
across the entire country.
Yeah.
Okay, we'll just keep pressing on. We'll just finish up, I guess. All right, so here is the whole premise is basically to sell $1,000 worth of a company you think that has bad times in front of it.
And
So-
bingo, you're back. Okay, great.
Okay.
I'm sorry.
Thanks, Ken.
I'm sorry, everybody. I don't know what happened, but you're all back now. So,
Fortunately, in 3 years, we've actually had rare instances of that sort of thing.
yep.
So that's good. So what I did for this one, again, as Ken was talking about, InMode is a company that I think has really been unfairly punished. if I could encapsulate the way I feel about it, first of all, they're well positioned and it's a well run company. They just happen to be in Tel Aviv, which is not the best place to be right now. I kind of think of them a little bit like EPAM in Ukraine. Hopefully the situation will be resolved fairly quickly and InMode will continue back on the path. And that's kind of the premise. Now they've taken quite a hit. You can see that they are down from an original purchase price of $22.40. They're down to 19 and change. So that's a pretty good chunk out of it in the short term. But Jabil, again, I just saw this as an overpriced situation that actually has more than made up the difference. So I could literally buy back because when you short a stock, you're literally borrowing the shares that you ultimately have to pay back. You hope to pay back less than the $1,000 you got to begin with, and net gain. I could replace the shares of Jabil for $866.81. That's what you're seeing here. Now Matt has joined the fray. Matt, do you want to lay out your thesis for why you would short a darling of this community, Eli Lilly?
I feel bad. I'm a former Hoosier too, so I feel bad. I know people at Lilly, and maybe I took my penance because if I'd done this right when you did it on the 12th, I'd probably be 10% ahead. Okay. I did there, and Lilly has deflated a little bit, but certainly the future is bright. They're going to make a mint on Mounjaro, their GLP-1 coming in, but right now they're a PE of 80. So even looking at Novo, which is a PE of 45, and thinking about where they might be at that point, I think a lot of the good news is priced in. So it's nothing bad. It's all about price. And then kind of the reverse. There's so many people or so many impacted parties you could pick against this. Basically the GLP-1 hype cage match. Everything, ResMed is pretty directly in there. Weight Watchers has its own problem, so I wouldn't do that. But even Intuitive Surgical, Medifast, certainly a lot of companies are directly impacted that serve people looking to manage their weight or lose weight, all the way to Walmart and McDonald's. People that help people gain weight indirectly have mentioned it. So it's going to be a big force, but it's really more about if market sentiment in these early days is overdone. So I was dithering in it. I'm also strongly tempted. I don't know if we get 2 entries. I'm strongly tempted to put Western Alliance against Bank of America. I think it's kind of picking on the runt to pick on Wells Fargo, which has its own sort of brown paper bag it has to work its way out of, and Citibank is kind of a basket case. But some of those major, say the too big to fail banks, have if you judge them by the same safety measures that you would judge a regional bank, they would not look so good. And Bank of America comes in that, as well as the fact that a lot of what's impacting market sentiment about banks now isn't the problems from March so much as commercial real estate. The fact that commercial real estate is now turning over because they tend to get mortgages of just 3 to 5 years in length and have to refinance. So that refinancing is coming a lot faster than residential mortgages. And when the worst of those are large office towers in central business districts like San Francisco, like New York, those are too big for the regional banks to have much of a say in. Those will actually affect a lot of non-bank investors where their debt has been collateralized, but straight in the arms of those too big to fail banks. So I spent my 2 weeks wondering which one is there, but I still want to do something like that too.
Yeah, we'll
Matt,
add. Go ahead.
It's really interesting, Matt. I told Mark that I had a couple that I was contemplating, but I wasn't going to talk about them yet. But since you talked about your bank one, I have one with First Financial against Wells Fargo. So I'll very much the same kind of reasons you have. So we'll have to see if I decide that's my entry and put it in there. How many entries are we allowed in this thing here, Mark?
I don't know. We're just making it up as we go. So
Making it up as we go. Okay,
yeah.
Matt, you can have 2 entries. Okay.
Well, if you got the bank, I'll be happy to stand by and cheer.
All right.
It,
Well, I'm
it,
using two different banks, but same general idea. Yeah.
Yeah, exactly. Same theme. We could be a tag team match. I don't know. Maybe we
Yeah.
call it, every card needs a good tag team match.
Morningstar came
Hey,
out with a list of 5 companies. We could turn this into a battle royale. Um, five companies that they would bet against, and I can't remember exactly who they were. Yeah, I've got them right here. Dell, of all people, Dell, XPO Logistics, the Trading Desk, TAL, I'm not familiar with that company, and US Cellular that they would bet against right now. And maybe we'll play with that a little bit also. Anyhow, all
let's
right.
let's not bring this analogy completely to the end here, okay, Mark? We're not going to put tights on them or anything, you know.
No costumes.
No costumes, okay.
Wait to see my
oh,
dragon.
darn. I have one too.
Probably a mask too, right, Kevin?
Yeah, it looks a lot like a guy from Savannah, Illinois.
Whoa. I don't know. I don't know if we're going to turn that loose on the East Coast. Anyhow, we started this last week. We basically said we were getting this type of question from a number of people. I had written to a couple of different clubs and just asked you to think about this a little bit. So I thought I would expand on it just a tiny bit. Now, I know there's a lot of words here. This is something that does get talked about quite a bit, especially when you make the distinction between beginners and more experienced investors. You don't want to move a fairly inexperienced investor into some of these, cyclical or startup or early stage companies until they've got some time on some experience doing it, because these are more difficult investments to move in and out of, and many of us have avoided them over the years. I can remember vividly it was actually at a national convention in Chicago when Hugh McManus nominated Amazon for the roundtable, because he got exactly 0 votes from a packed room, and Ken stole all the votes with Gentex, as I recall. So we have talked about this in the past, and we're pleased that he did select Amazon. You can see the results there on the right. And if you want more on this subject, you can actually go to our forum. If you're not a Manifest subscriber and write to me, I'd be happy to send you the PDF to this session or whatever. But you can go to it on YouTube also. Just look up the October 12th. It's actually 2 years ago, where we talked about this particular subject of how to look at some of these companies like Amazon and Tesla. And we covered a number of companies. So we just urge you to do that. And it was kind of the entree or appetizer to our series on the projected return on value that you see mentioned there on the lower right in the cover story at that link at the bottom. But and then I don't know if Ken is still with us or not. I think Ken
Yep,
likes
I am.
Ken likes the nutshell. You don't have to do this, and you really can stick strictly with up, straight, and parallel. Almost all of those companies in our Magnificent Seven fit that bill. So again, just something to chew on a little bit and a way to dig in. It can be a very rewarding area of investing also.
Yeah, and Mark, I want to add that these percentages that Nicholson talked about are suggestions. And if you're more comfortable, if you'd like to do a little bit of it and you're more comfortable with 5 or 10% of your portfolio in non-core, then that's what you do. He's just suggesting that once you get past 25%, you're probably beginning to engage in some fairly risky behavior with the entire portfolio. But if you're more comfortable at 10 or 15, then do 10 or 15. And if you're not comfortable at all with dealing with these kind of stocks, although I will say that there's a number of stocks on that list that do fit the up, straight, and parallel model and do fit the consistent growth model, Microsoft among them. Don't discard them all because they happen to be talked of as doing really, really well. Some of the ones that are doing really well are doing so because of the reasons that we believe are important. So it's a great thing to add a little bit of interest to your portfolio and occasionally to add a home run to your portfolio as well.
Yeah, I will say that I have fairly religiously, even with my personal investing, split it kind of 80 core, 20 non-core. And the non-core has so magnificently, there's that word, Kevin, outperformed the core over the last couple of years. It basically made up for a couple of sluggish stocks in the personal portfolio. So, I mean, it really has been relatively spectacular. Among those is Ardelyx. I do own shares of Ardelyx, and that's gone from under $1 to today it reached $4, and we hope for better days ahead, going ahead. So, yeah, those type of investments can be quite rewarding, but they can cause some sleepless nights also. It's all up to you as to who you are. And then the questions continued with, is there any data that basically suggests how individual clubs have done investing in these type of companies? And a couple of points. The roundtable includes non-core stocks. Not a lot of them, but there's a few. And it has achieved a 15 or 16% rate of return over the last 13 years. And as Ken can attest, the model clubs in his area are basically all, and a couple of them are significantly outperforming the market, but they're all beating the market. And some of them do adventure a little bit. Your thoughts on that, Ken?
Well, you're being very polite. Some of them adventure more than they should, but non-core stocks are not something that are immediately outlawed. You take a look at them, and you do have members in the club that whose sole purpose, my wife among them, I know her sole purpose in one of our model clubs is to remind people that core should be, and we use the 80-20 model, so that core should be 80% of our portfolio, and think long and hard before we put money into non-core stocks. We don't talk about the non-core disasters that we've had, but I'm sure you've had a few, Mark, and I know that our model clubs occasionally will have a non-core disaster. And when it happens, it happens. That's just part of investing, and hopefully you haven't bet the whole portfolio on a single non-core stock.
Yeah, just recently I bought a call, which is a form of buying some stock, but a call on Hawaiian Electric, thinking that was going to blow over, and it blew over all right in my direction. And that one didn't. I still have it open, but it's not working out very well. So again, Kathy Wood, she's taken a lot of heat for her fund, which is extremely aggressive, mostly non-core, mostly early stage. She has a lot of companies that don't have any earnings. So she's actually a pretty good living demonstration of the upside and the downside of that type of investing. So again, as Ken said, every once in a while you're going to get a hold of one that you wish you hadn't. It's just a pretty strong reminder, and her experience is a good demonstration. Does better investing compare how the clubs are doing with the general market or the Russell 2000? And yeah, over the years, the better investing community has always been compared. We used to use the club portfolio contest to do it, and that would have been self-selecting. But I will tell you, the spectrum of performance levels was a bell curve. It was a nice bell curve, but it was still a bell curve. So it wasn't just the top performing companies. And as far as I know, they've really only used the top 100 index to gauge performance recently. And the one caveat that I would have for that is that's going to have a very strong large cap bias. And just something to keep in mind. Your neogens are not going to appear in the better investing top 100, those type of companies. And those can be a very important part of a club that does all of the above investing. A good blend of small, medium, and large. Your thoughts, Ken?
Absolutely true, Mark. It took a while for even Cognizant Technology to begin to appear in the top 100. And we know the kind of performance that company's put in over a long period of time now. So the top 100, I think, also has a bias that you have a lot of stocks that clubs have been holding, and they hold them because they don't want to sell them because of the capital gains they've made on them. I think that a lot of clubs are in that situation with Apple, for example, and they just don't want to. They don't want to harvest the capital gains from them, rightly or wrongly. I think we could have a great debate on whether that's a good decision or not. But I think it's being done, and it's being done in many clubs. It's there's just, if you want to put this thing with all the numbers and get it all down to the last decimal, then we're speaking to that engineering population again, and guys and gals, we're just not going to be able to do that. The clubs are too spread out, they're too private, they're too they use too many different ways to pick stocks and to maintain their stocks, and even to do the accounting for their stocks. So getting all of them in one place where we can collect the data is not a task that I would want to even begin to pursue.
I'll add 2 points to this. One, I'll agree with you that there is a large cap bias. Keep in mind that the S&P 500 is about 75 to 80% of the entire US market. So therefore, the entire stock market has a bias towards large caps. So keep that in mind in the whole equation. And even if you're buying the ones that aren't in the Magnificent Seven, that's going to happen. And the one thing they'll say about the top 100 now is because it's not a self-reporting, but it's all the people that are in the My iClub club accounting, it's probably a little bit more representative than those that were just self-selecting and submitting. So
Absolutely. Yeah, and it's still going to be biased to the companies that are on the TV the most often or in the headlines the most often. I think what I'll probably do at a future session is take a look at our top 40 versus the Bivio top 100 versus the Better Investing top 100, and just see if we see anything. So we might take a look.
That would be that's something I'd find very interesting. Go for it.
All right. Coming attractions, we are going to be talking about early stage investing again, lessons learned from the Kathy Wood experience and stuff, and then we'll other stuff. If you've got anything in mind, any subjects to suggest, let us know. We do archive all of these sessions on YouTube on the Manifest Investing channel. That includes the bull sessions and roundtables, and you can go back and find those sessions we referred to a couple slides ago, going all the way back to 2021. And there were multiple sessions on early stage investing and trying in an attempt to place PE in its proper context. So those are a lot of fun. And we will close with one more time with David Carson and Ken in St. Louis and Mark Robertson not pictured on the left. And I just want to show you what David is up to these days. And he is out experiencing the colors along with you, Ken, only this is down along the Great River Road near St. Louis, Southern Illinois. And that's David on the left there. That's his Twitter post. All right, anything else in the hopper?
Mark, if you could real quickly before you wrap things up, go live to the Manifest site and just show the audience where they can find all of the portfolios that we've been talking about today, the ones that are listed easily to find.
I think I can oblige. Let me attempt. Okay, can you see the page on screen?
We can see the page, and you have to scroll down now.
Okay.
Yeah, there we go.
I mean, the quick one right here is the very first headline, Fortune 100 fastest growing companies. Clicking on that link will take you to a couple references. And right on here will take you to the link of the actual portfolio. And I believe that's 100. Wow. ARC Best and Customers Bancorp have been going crazy. This gives you all 100 that you can go down and take a look at. And again, you could sort them by highest quality. Can you still see that okay, Ken?
Yep, it's coming through nice, Mark.
Okay, so that's how you might get the fastest way to get to the Fortune fastest growing companies. It is a public dashboard. Going back to the home page, the other way to get to one of these portfolios, I'm going to give away a secret here, I think. If you go to the published dashboards on the lower right-hand side of the page, the right sidebar, go down to the bottom, click on more, and then as Ken mentioned, you'll see best small companies. So if you want to see the companies that we selected a few years ago, you can actually go back and take a look at them. And here's a work in progress if you want to cheat for tomorrow. This is not a final list, but it is a work in progress. Best Small Companies 2024. And then if you go down to, I think I put it here.
There's under the word Forbes is the Forbes list of best small. You just went past.
Yeah, so right here, Forbes Best Small Companies 2023. So keep in mind, here's the date stamp, 2022. And by the way, we were saying these same exact words, are pretty close, a year ago, Ken, and we got our heads handed to us. So did Greg Fisher.
Yep.
Best time to invest. If you click on that, you will be taken to the list we talked about today, sorting it by quality. You can see the companies that we had up on the screen, with a couple of exceptions. Some of them moved around a bit. And down at the bottom of this one are some uncovered companies that I'm going to be looking at coverage on. A couple of those did look a little bit interesting and potential candidates for this year's best small list. But you can see that many of these companies are single digits and below, or lower single digits for companies when it comes to growth. And they're not going to be making our best small company list. Okay, does that help, Ken?
I think that answers that question real nicely, Mark. Thank you.
All right, so tomorrow night, the link to that would be over here, October Investing Roundtable. We will start the session at 8 p.m., and Ken and I will literally whip through our selections, somewhere between 16 and 20 of the best small companies. The theme is, I'll show you the theme. Can I do this, Ken?
Yep.
Our theme is going to be rolling back. We're going to go back and not try to get cute with the roll of 5. We're going to go back to on the order of 20 companies, and we are going to roll back to our quality standards. Stick to our quality standards and see how well we do, because when we make this presentation, you'll see that the last 2 years have left us wanting for better performance. How's that for sugarcoating, Ken?
That's a really nice way of putting it, Mark. Very diplomatic. Okay.
All right. Anything else?
No, I think we're pretty wrapped up for today. Thanks for coming, folks. We really appreciate it.
All right. Thanks, everybody.
Oh, Mark and Ken, I gave you some homework.
You did.
Yes. I was just, as you were chatting about